Hey you guys, welcome to our March meetup. Look, we've got a little bit more time left on the networking segment of tonight. So, if you guys aren't here, you're missing out on the networking with different people. We're about to get started in about 4 or 5 minutes, okay? Alright guys, at 7:30 the speaker will come on and you'll get to hear more about tonight's topic. Alright, see y'all then. Well, it's very easy to sit here and not go home having met one extra person. It's very easy to do that, but that's one of the biggest benefits, right? Would you guys say? I've done deals and made money from networking with people in this room. You can too. There's literally nothing stopping that. Has anyone else done a deal with someone else in the room? I know I hear the story. I know I hear the stories, but so deals are going on in this room. Money is being made. So get to know who else is in this room and see how you can work together. Okay. So we're going to get started. Tonight we're doing something a little bit different, where it's a little bit of an interview style, and we'll see how it goes. Okay. All right. You guys excited?
Sure.
Woo, go ahead. You know what? I like it, right? There you go. So back in the step for a few of you guys, right? All right, so guys, this is Mr. Bob Norton with Norton Accounting Services, right? I know his name was frequently coming up to me between different brokerages and different investors that he's a real estate specific CPA. So he was someone who I wanted to bring in to talk about these topics because we're all in the thick of it. It's tax season right now. Him more than us, you know.
Yeah.
But so it's an important fact to all of our lives and our businesses, right? So tonight we want to talk through some questions. You're welcome to ask questions as well. We're not just saying sit down, shut up, and listen. Like, ask questions too, and we'll kind of just go through here, okay? Good? We're in agreement here? Okay. So the first question I want to ask Mr. Bob is, what are some common misconceptions that you see people make regarding, or like their mindset about taxes in general? What have you found?
So, when Courtney sent me the list of questions that she wanted to go over, these are going to be big picture. We're going to talk about really big concepts. We can drill down if you want to, but these are bigger concepts. And some of the stuff we're going to talk about are ideas that a lot of my clients don't think about because they're in the weeds. They're not seeing everything. So, how many of you guys have read Napoleon Hill's Think and Grow Rich? See some hands? Well, one of the principles, there are 17 principles in that book. So if you haven't read that book, by the way, you should definitely read the book. One of the principles in there is accurate thinking. So to become wealthy, you have to look at facts, and you have to look at data, and you have to make decisions based on that. Well, taxes are just simply a cost of doing business. Everyone tries to avoid taxes. They do everything they can to avoid taxes. Well, the only way you can avoid taxes is lose money, and that's not a good business plan.
I don't think any of you guys trying to do that.
Now, there are a lot of people that try not to report everything, and that can lead.
What was that? What was it?
I said, that's what I've been doing wrong.
All right, we found a common misconception. All right.
So one of the misconceptions is part of that in running a business is you need to plan for paying taxes. You know you're going to have to pay them, so you should basically have that as part of your business plan. And the small business owners have it like a catch-22, in which we try to write off everything we possibly can to save our taxes, but then when we go to the bank to try to get a loan for something, they say you don't have any income, or they can't. We have cash. They said, I know you have cash flow, and the bankers all know this, but because they have to follow all the rules that are set by the Fed mainly, you have to show income, and so what I come across a lot is people that they just always want to, what can I do to save more tax? I said, well, you need to start thinking about what do I need to do and grow and make more income. And just realize tax is a cost of doing business. So that's
like you're never going to eliminate it. It's just strategies you've got to build. It really doesn't matter how much money you make to a degree. It's what you take home. But you're never going to fully eliminate those taxes. So it does matter that you are also strategizing on more ways to make more money.
Right.
And prepping for your taxes. I read a book called Profit First by not Mikowski, something. But Mike something, it's on the resource page, called Profit First, where he talked about having like different accounts at your bank. So one of my businesses, I have like 5 accounts. I have an operating account, I've got a reserves account, I've got a tax account. And it came from the idea from this book, maybe you've heard of that book, but, and the idea of it is, okay, say I make $20,000 off of this one deal. I know Uncle Sam's gonna like ask for part of that. And so many people don't think about tax time until it comes to tax time. So a smart idea is almost like budgeting for it, right?
Mm-hmm.
Would you agree?
Yeah.
So what else as far as mindsets of people who are trying to eliminate taxes altogether? Did you guys understand what he said by trying to make your income really small on paper by writing every little thing off? But then when you go to the bank, how many of you guys have ever gone to the bank and they denied you because of that? Or you don't have to say denied, but you've come across that issue. They said, hey, be careful. So when, I know I've come across it, they're like, hey, be careful because on one hand you want to like have on paper that your business is like for the IRS, you want it to be very little income. But when it comes to the bank, you want to say, oh, this person makes good money. You want you want high income so that they can then lend to you. It is a catch-22. Where do you find, what do? You want to be able to get loans for these properties. So.
Now, one of the big things about real estate and the beauties of real estate is that we can write, if you're investing in rental properties, for instance, or commercial buildings or whatever, it's like you can write off depreciation. Well, you're going to have these big losses, and the bankers understand that because they don't see depreciation lowers your tax, but it's not a cash flow thing. So what you want to do is you want to structure your business so that you're paying yourself a salary, so that you're showing on the tax return, look, I'm getting wages, I'm making money, but down on this line up here, but down on this line where it has all my investments, I'm losing money because I've got depreciation. And the bankers go, okay, we can add depreciation back, and that shows us how much cash flow you have, and oh look, you qualify for loan. So you have to think about how you structure your businesses and look at your cash flows and figure out if you want to get a bank loan, how do I need to show this to get the bank loan? And still write off as much as you possibly can write off.
Just strategically do it.
Strategically, yeah.
Okay. Did you, before we move on to the next question, was that you covered about what you wanted to cover?
Yeah, only one other thing that I have is several years ago, before I got into tax preparation and everything, when I was running some companies, I had this guy tell me, he's like, he had a buddy who owned a company and went to his tax professional, and the guy said, you made too much money this year, you need to go buy a new truck so we can write it off. And so the guy went and bought a new truck. And I'm sitting there thinking, that was the stupidest thing I've ever heard. Now he's got an extra truck. And granted, he might have been in the construction business or whatever, but he's got this extra truck that, number one, he didn't need. It's just sitting there. And granted, he might putt around in it or whatever. But so he took good money and spent it on something just to save tax. Now think about this. So it's like when you spend $1, just put it simple, you get, depends on your tax level and everything, you get to write off about 33 cents in taxes. So if you spend money on something that you don't need or it doesn't create value for you in some other way, you're out 67 cents that you would have otherwise had you just kept $1 and paid the 33 cents in tax. So that's the difference between scarcity and abundance mindset. So abundance is like let's grow and let's keep this thing going. Scarcity is let's think small. Let's keep going. Keep getting less and less and less and less, and then the next thing you have nothing. So
right. So I do see that a lot where people are like they're spending extra money just because they get the tax write-off for it, but it's like they don't realize that they're so nearsighted with the taxes that they don't realize that they're spending all this extra money and they're losing the 67 cents.
Yeah.
And that is one of the things where it comes into, it's about your mindset about taxes. Some people, they're like, oh, well, that's, in April, I just take the shoebox and I throw it across the table and say, figure it out. Or it's like, there's a level that your mind has to like shift and change where it then becomes, when I make a purchase, it's how is this going to affect me tax-wise? When I wholesale properties or when I buy properties direct from sellers, I'm asking them, one of the questions I ask them is, have you considered how this is going to affect you? Have you talked to your CPA? Have you considered how this is going to affect you tax-wise? Because they may have had this rental property for 30 years. you know, and they're like, oh, well, I haven't even thought about it. One of the properties I was going to buy, because of how they bought it, the value of it when they bought it, all these factors, their CPA said that it was going to be a $23,000 bill that following year. And they're like, wait, I don't want to sell. Didn't mean we didn't do the deal, we just structured it differently. But it's, again, buying, selling, you need to have that in mind, like have your mindset say, hey, what's going on here? How is this going to affect me tax-wise? And just have that in the back of your mind. Now, do you not sell? No, you just find a strategy that you can use. All right?
Right.
So, so the next question is how should someone, you know, everyone says, you know, treat your investments like a business. How should someone do that when it comes to taxes? You know, say someone has a rental property, or, you know, they do some flips, or they maybe have a few rentals.
So, well, the first thing is you have to think of it as a business. You know, people think of it as an investment or just have this income source, but you got to think of it as, once you start thinking of it as a business, then you step back and saying, what do businesses have, and what should I do as a business? And one of the things is you need to set up a business entity for it. You need to set up a checking account for it. You do everything a normal business would do. Then you need to have an accounting system. I mean, this is bigger than just taxes. This is just, you need to run it like a business. Because it turns out that if you do that, what happens is now you're tracking data that you can then go back and compare from year to year, and you can see what you're spending money on and see if you're overspending in certain areas or forget that you're paying for this service, and it's just coming out every month because you're not checking anything anymore. So by tracking your data, you ultimately save money and spend things on the right stuff instead of the things that just throw the money away.
And I find that, so I've bought, I think last year, 2 or 3, maybe 4 properties from landlords who, it was their only rental property that they had for, you know, 20, 30 years, and they did it so they could prepare for retirement, right? That was their meal ticket for retirement. But they didn't treat it like a business. That's part of the reason why I ended up being the person that they sold to, because it wasn't managed correctly. You see that sometimes in landlords who like don't screen their tenants, and then they just let in whoever has the right money, you know, the right amount of money, and they let him in, and you never know, Joe Blow comes in, he's gonna, you know, come in like a wrecking ball and like destroy it, right? So there's this level that when you don't treat it like a business, it can come back around and bite you. So many people, if any of you guys are in that Southeast Louisiana real estate investor Facebook group that we have online, it's kind of like a forum. I shared a post about how it was a guy who was a flipper who was doing one of his first flips, and he was pinching pennies that he didn't hire like a general contractor to manage the deal. And here it is 2 years later, and the property's abandoned, and he's lost so much money because he's been pinching pennies that he lost money in the grand scheme because he was just trying to save, and he didn't realize that it was ultimately what was, I mean, the guy's losing money left and right in the property now, right? So with it is, it's just mindset of treating your investments like a business so it can pay you like a business. Don't treat it like a hobby. Hobbies rarely ever pay, right? You know, right? Does that make sense to you guys as far as treating it? No, none of us really enjoy accounting. Really, I don't know. If you do, you're an anomaly. You know, I mean, but yeah, like when it comes to accounting, I know that in my businesses, I've got receipts, I've got services that I'm buying, and all of that, you know, that people I'm paying, contractors, or, you know, just different things, running this room, different things for the different businesses. It's like, that's all part of doing business. But when people put it all in a shoebox and say, here, figure it out, it's there's no strategies involved with that. You can't see, wow, I completely overspent. Like on a flip, if you're not trapping your numbers on a flip by accounting properly, how do you know when you go over budget, right? How do you know if you're eating all your profit?
Right, exactly. And the other thing too is that, you know, if you're doing a flip, you usually have a budget for what you expect to spend, and you can track your expenses that way. But if you're a wholesaler and you're just flipping properties by transferring contracts, what you have to know is what does it cost you to operate, and by tracking that, you'll know how much do I have to do to cover this, plus the taxes I'm going to owe and everything else.
Do you have a software that you like to use to do that, or?
So, well, it depends on how sophisticated you want to get it. QuickBooks is a really good software, and the beauty of QuickBooks is that if you key in all your transactions from the bank, your checking account for your business, and you reconcile it every month, it's pretty much tracking everything for you.
That's the one I use.
Yeah, and it's
That's
real
my
simple to
husband's
use.
too.
Now the one thing about that is that if you have multiple businesses, you probably want to get the desktop version of QuickBooks. Sort of going off, but anyway, it's like, because you can have multiple companies,
That's my
company files. If you use the online version, they're going to want to charge you $35 a month for every company you have. And so,
Well,
one thing I want to mention about the rental business is like treating it as a business. So if you're a legitimate business, you're setting aside money for reserves for the future repairs and everything else. And you also want to think the money that comes in for your rental business is the money for your rental business. It's not your money yet until you've got the reserves set aside, you paid the mortgage, you paid all this other stuff. And so you want it to build up. And so the most successful rentals that I've seen are people that they set it up and they manage the tenants and everything, but they basically forget about it. You just let it go. And I have a rental like that I literally forget about. And oh look, how much money I have in the account. It's like, but that's one way, because if you get a good tenant in there and everything, but you just build up the reserve. And every business needs to do that, because you're going to have to replace a roof one day. You're going to have to repaint. You're going to probably have to refloor it. It's like there's a lot of stuff that you're going to have to do. And you need to plan for that. So you can actually calculate what that number might be and how much you need to set aside every month, or how much you have to build up to, and then you just let it build up to that.
Steve, I don't know if you can account to this, but don't you guys look for actual reserves when it comes to lending for a rental property?
We do, like, we actually have an investor cash flow. I'm a loan officer, by the way. We have a number of programs as well as traditional lending, but we also do portfolio products. And one of the programs we have is investor cash flow. We basically don't even use the personal tax returns. We hold the property accountable for getting the mortgage paid on the property. So basically, we'll take the average rate and we give it $1,000. As long as your payment for whatever you're borrowing, taxes and insurance, does not exceed 90% of the $1,000, is probably a good deal. So what we do, we also ask for 6 months reserves for each one of those payments for each property. So if you have 10 properties and you want to do the 11th one, then they're going to want to see 6 months reserves for all of those properties. And I believe now, I think they're getting ready to change it to 3 months reserves for all those properties. But they'll allow you to hold up to 20 properties, they'll do 4. So you can only really do 8 through traditional lending. And after that, you got to go find somebody else that's going to offer, a program for you. So,
Right.
but and yeah, the reserves are big. So they want to make sure the skin of the game, right? You get the ability to do that.
So we're going to be talking about bond for deed next month, and we've, later on this year we'll talk about wholesaling. When we're going to speak for that, we talked about subject to in January. We talked about these different things. There's ways that you can get into real estate that's budget friendly, but it's almost like a car. You can't get into it with no money. Like you can't buy a car, even if you can buy a car, say on payments, right? Say Mia has a car and it's $1,000. She said, give me $10 a month, whatever. Stupid numbers, right? I can't buy this car with zero money in the bank because eventually I'm going to need to change the oil. I'm going to have to put gas in it. A repair is going to come up, right? Stuff I change my oil. I have to get new tires, new brakes. Things are going to come up, right? So even though I can even do a creative way of buying it, I didn't have to have the $1,000 up front. I could do a creative way to buy it. If I don't have money to work with and like reserves, I'm going to be a sinking ship when the first, I have to go pay gas in it the next time. Since I don't have money, I'm going to be pulling it. So whenever we talk about these creative ways to do real estate, realize there's ways that you can get into real estate with little money, but there's not really a way to get into real estate with having no money in the bank. Does that make sense? Okay. So I know we hear that a lot is, hey, this is a great way, no money. We can talk about some ways, some strategies. There's some great ways of doing things similar to like wholesaling and whatnot. But when it comes to having like a rental property, eventually that AC is going to give you issues. Eventually that roof's going to be at the end of its lifespan. Whatever it may be, okay? So reserves do play a part into lending. Just be a landlord in general.
So I want to mention one other thing is this, so for the questions that follow up, this sort of plays into that, is that there's two types of income basically. You have active income and you have passive income. Active income is income that you earn from a job, but it also is income you earn from fees, services, or whatever you provide. You pay income tax on that, but you pay self-employment tax on that. And in this new tax law we had, they didn't change the self-employment rate. It's still, they want 15.3% of every dollar you earn on top of any income tax. And the only thing you can do to reduce self-employment tax is have expenses, because it's based on your net business income. Passive income, however, is exempt from self-employment tax. So rental income, by definition, is passive under the tax law. Even if all you do is rentals, and you're the landlord, and you're going around and doing all the work yourself, that's your job, it's considered passive, you don't have to pay self-employment tax on that. So what you want to do to save taxes is to make sure you look at your cash flow streams and you structure things so that you're making sure most of it's going to be considered passive. And then some things you can't get away from it, it's got to be active, and that's where your job is or whatever. And the way you minimize tax there is by electing, for instance, to become an S corp. Set up an S corp so you pay yourself a salary and you fix the tax of your salary, and the rest of the income that you make flows through to you as distributions or profits, and that's considered passive income, and you get taxed on it. Normal income tax, not domestic tax. So this is a big deal when you're looking at flipping versus owning rentals. So
The IRS sees them differently, which is why so when it comes to earned income, that's going to be like flippers, rehabbers who are flipping houses for, get that we all want it to be a great big check, right? You flip this house, you turn it from ugly to pretty, you get a check, you're like, woohoo. You get wholesalers, you get that check, hey, this was you got an assignment fee or double close. Then you got agents, brokers, they're similar, it's all earned income. So these are all seen as the earned income. And then you've got the passive. This is going to be like the landlords, or if you're doing like owner financing. One of the things is I'm actively starting to hold, and I realize I have only one entity for all my investments right now. And so one of the things I'm looking at this year is to separate the two, have one entity for all my flips and my wholesale deals, and then have another entity for all my rentals or my owner finance deals. Because not only are they seen differently from the IRS, but they're seen differently from a liability standpoint. One of them, it's quick and short. A flip is like usually 1 to 3 months, or a wholesale deal, less than a month. Then you've got the rental. You want to keep that for a long term. That's a long-term risk, right? So from an insurance standpoint, all these things, it's just different. Also, entity-wise, they're just different. You got to protect yourself. You may have, that flip's going to be, you're holding it for a short period of time versus the rental, you're hoping to have that for a good period of time. Does that make sense, you guys? Like seeing that those are different. In real estate, there's a lot of different ways to make money, but realizing that the IRS sees certain activities differently, and that can have an effect for, not just throwing everything into the pot. I don't care if we like gumbo or not. It might not work in this sense, right? Like, again, we want to talk about ways to change how you think about taxes and change your mindset so that you can maximize your business. Again, it's good if you're making money, but if you're getting rid of all of it, it may not be. You've got to change the way you think, kind of think through some strategies. So, on that topic, what are some common money-losing mistakes that those with that earned income, flippers, wholesalers, agents, brokers, that you're seeing people make?
So one of the big things is, first, I mentioned this earlier, is not looking at the tax consequences of how you set up things and how you do things. And also not segmenting your income, because a big thing that I do come across, and this happens a lot, is a real estate agent will set up an entity for their real estate business, and they'll also use that for buying and selling houses, and or buying rental houses or flipping houses. And it's like, that's okay if you're flipping houses, but sometimes if you want to hold things for a long period of time, you're going to want a separate entity for that. But if you put it all in that one entity, the IRS is going to look at that entity as a dealer or a flipper, and it's like it's all going to be active income. So you have a problem getting away from that. And then talking about the dealer status. So a dealer status is someone that, if the IRS considers your business or you as a dealer, they treat the real estate that you own as if it's inventory. If you don't get to depreciate it, you can't do a 1031 exchange, you can't do owner finance, you don't get capital gains on it. When you sell it, it's considered SE income. So a construction company, for instance, is in essence a dealer, because they're only in the business of building up the home and selling it. And that's just regular income, active income. But if you occasionally fix up a house and sell it, then you could still be considered an investor, and that could be passive income. But if you do it a bunch, you're going to be considered a dealer. So you have to structure your life, and you have to structure everything so that it's not obvious, and it's also part of your intent of what you want to do with the property and how you set up everything. You don't want everything to be considered active income. You want passive income in there.
I think that's the big goal.
And that's the big goal, so you have to be careful on how, going back and think about the tax consequences. How do I want to set this up? What do I want to do with this property? And then, and setting it up and doing that. And, but that's the biggest thing, is buying rental properties in your active income property and just having one entity for everything. That's the biggest mistake.
Is there a good mix between the two?
Pardon me?
Is there a good mix between the two?
So, well, like Courtney said, it's like you want, and I've heard this years and years, like you want a flipper entity and you want a rental entity. Well, it's like I get more complex than that, but that's basically how you can look at it. Now, the other thing I want to mention also is that if you subdivide land, you're a dealer. Now, you can subdivide, you buy a property, or if you inherit a property, you subdivide part of it, you sell off part of it because you got a farm or something. And then, if you do it once, the courts have basically said, no, you're not. You're just subdividing the property. But if you buy a lot, or some acreage, and you subdivide it into 12 different lots, the IRS says you're a dealer, and the courts have decided you're a dealer. So you have to structure things so that if you want to do this, so if you want to buy 10 acres, you want to create acre-sized lots and put 10 homes on there, and you want to rent those suckers out, well, you first have to set up an entity that's going to buy the property. It's going to go through the subdivision process, all the filing, all the forms and the permits and everything, setting up any kind of horizontal stuff, roads and all the other stuff that you would do to get access to it. And then that entity then sells lots to another entity you set up that's going to be a rental that then builds the house. And that way you capture everything in that. And then you're going to, in the entity you set up to subdivide the property, you still, it needs to earn a profit. You can't sell it at a loss, because then the IRS will blow through the whole thing. But it doesn't have to be a huge profit, And then, of course, it's just selling land with whatever cost you have in there. You would have those costs anyway if you bought it. All you're doing is just shifting it from one to the other and transferring some stuff for overhead costs and expenses that you had. So, but you have to be careful. That's one thing, because I have had a client that bought property, subdivided it, and I told them, like, whatever. And then years later, they said, they came back and said, oh yeah, we did a 1031 exchange on this property. I said, no, you didn't. I mean, yeah, you did it, but that's not really what happened, because you paid all the extra fees, and we can't treat it as a 1031. And then I got all, I said, because remember all the stuff I sent you before? Why didn't you call me first? I would have said, here's how you do it. So
that might have gone over some people's head, but the reality is our actions have consequences. Buying, selling. Again, we should be thinking, how is this going to affect me tax-wise? Again, if those landlords would have sold me their rental property and not thought about it, next April their CPA would have been like $23,000, please, for this transaction. Talk about a gut check, right? You'd have been like, that turned from a happy moment of getting rid of the headache tenants to an even like a terrible thing, right? Like, so.
Especially since they spent the $23,000 on that new Mustang sit down there.
Right. Well, no, the RV to go travel.
Oh, the RV to travel, yes, yeah.
They're like, then all of a sudden they just spoils that retirement nest egg they thought they had built, because they're like, we're going to keep this as a rental, and then we're going to sell it, and that'd be our nest egg for retirement. IRS comes in and says, $23,000, please. I think of the IRS as one of my biggest, I don't think subcontractor is the best word for it, but one of the biggest
They're a partner. They're a
partner in
silent
my
partner.
business.
They get a cut no matter what.
Yeah, and so it's one of those things where I'm like, if it's one of my largest ones, I want to be an engaged participant. Again, not just putting the shoebox of receipts across the table and say, figure it out. I've read, of many books I've read this year, I think 2 of them were about taxes, and then one of them was about taxes, one of them was about entities, and I've got 2 more scheduled for the year. I'm not trying to be at his level of educated, but I'm trying to be an educated participant sitting at the table. Does that make sense? Because he's not in my back pocket all day long. I mean, technically, there's a phone, and the way technology, there's a level. But you know what I mean? Like, I don't want to just say this is for someone else. There's a degree that I have partners in my business, and I want to be a good partner in return with, say, the CPA on my team, because the CPA on my team is not making all my decisions. As a business owner, the buck stops with me, right? Like, I'm making the decisions. He can say swipey, no swipey when it comes to like making certain purchases. He's like, hey, these are hurting you. Y'all didn't catch that, like, what is that, Dora Explorer? I don't know. You can tell I have nieces and nephews. But, alright. But you see what I'm saying? Like, you want to be an active participant. So that's for people who have earned income. Real estate agents, flippers, and wholesalers are usually the people grouped into that. Now we've got the other side, which is the passive, which a lot of us are wanting. A lot of people, that's the goal, is to have the rental properties, that passive income. So that's going to be the rental properties or the owner finance stuff. Again, it's kind of like a chunk every month for a period of time. What are some common mistakes that people are losing money on for the passive income?
So, for passive income, the biggest problems I see are people that they buy a rental property in a corporation as opposed to an LLC, and or another active business, which I mentioned before. So you could have the reverse, where it's like, they use the active business to buy it. But the issue with the corporation is, if it's a full taxable corporation, you're going to be taxed on it twice.
So like a C Corp?
That's a C Corp, which I don't see too many C Corps, because most small business people immediately elect to be taxed as an S when they set up a corporation. But you can also have an LLC that's taxed as an S. And an LLC taxed as an S, as far as IRS is concerned, it's a corporation. You're going to follow all the corporation laws. And there's some terrible laws when it comes to owning passive real estate corporations. One of the things is, you can't count as part of your basis is the mortgage you have on the property. So if you have a loss because of depreciation, you can't take it because you've wiped out all the money you put in. You're okay, because from a cash flow standpoint, but you have a depreciation loss that's more in excess of what you invested. So the IRS says you can't deduct that until you're at risk, which means you have invested more money or you make profits in the future. So, whereas if you have an LLC that's not a corporation, it's just an LLC, it's like you get to count the mortgage as if it was your investment. And so what happens is you can take those losses. You can have a negative capital account in an LLC, but you can't have that in a corporation. So
your entity structure matters.
So entity structure matters. So
in general, that it matters, but you see that as a mistake.
It used to be that the only entity that you could use for limited liability was a corporation. But now, LLCs in Louisiana have been around since the early 90s, and the rest of the U.S. pretty much adopted LLCs. And so you definitely want to use LLCs for your rental properties. The other thing is a big one is not paying attention to the timing of your sales. So if you want a long-term gain, long-term taxable gain, is taxed at 15%, maybe 20% at the top, depending on what your other income is. And sometimes it's free, it's zero. Capital gains rate, lowest one is zero. If your income is down below a certain level, and as small business owners, we can get it down to that level and then have a very low taxable gain. But I had a client who bought a property on July 1st one year. He sold it July 1st the following year. Short-term gain. That was 365 days. You need to keep it for greater than a year, which is 366 days. The dates matter.
And is his intent to rent, or was it?
Well, he rented it, rehabbed it, and rented it for stuff, but they ended up selling it, So he had it as basically a flip with the intent of renting it out for a period of time and then selling it to whomever. And it turns out they just happened to close on the same date, 365 years later. And it's everyone thinking, oh yeah, that's been a year. So that's not a year yet. You got to do it on the next day. You got to count the days. And the other thing is, when it comes to the end of the year, if you close, timing matters. So say you have something that's going to close in December, and if you wait a few more days and close in early January, guess what? That money's not taxable for the next year. You don't have to pay for tax in April. You can wait a whole other year for that. The guys who want to close on the last day of the month, other than the fact that you want to get the deal done, but they're the mortgage brokers, the closing attorney, they want to book the business. They want to get their commissions. They want to do all this stuff. So timing matters. Look at the dates and make sure you're closing on the date that you want to close on. Granted, the buyer also has some say in this, but usually you can work that out and it's not that big of a deal to them. And then the thing to consider when you're selling with owner financing. So the timing matters on that too. So if you sell with owner financing, the nature of the gain that you have is based on the date when you sold it for how long you held it. So if you have a property and you've held it for less than a year and you sell it with owner financing, guess what? You're spreading out the gain, but you're going to be paying short-term gains for the whole time. It's not long-term gains, it's based on the date you sold it. So you got to make sure, if you want to pay long-term gains and you want to spread that out over however many years, you want to make sure that you've waited 366 days from the date you first bought it. Now, another thing that you can do, another strategy is if you're buying lots or you're buying properties, and you can buy them with intent to fix them up and rent them out, but you don't have to immediately work on them. You can buy them and let them season for a while. You've got it under contract and you close on it, and granted you're going to have holding costs, but if they're not too much, especially if you have lots or land, then you can hang on to that for a few months before you start doing stuff, and that way it gives you some time before you then sell it, because it counts from the time you bought the land or you bought the property, not the date you finished the house. So, timing matters in with the tax stuff. Those are the biggest issues with the rentals, other than putting it in the wrong type of entity or putting it in your active entity, not paying passive income tax.
I know that from horror stories, I found something was that someone didn't have, I don't know if you guys are noticing that he may not sound like your CPA in the sense of real estate specific experience. I had a colleague who had some rental properties, and when they actually started getting involved looking at their taxes, they looked at their back taxes and they saw they were never getting depreciation written off in their rental properties. Maybe the CPA didn't know about it. That's huge. They were losing out on something very, very big when it came to as a benefit to having your, having your rental property. And so it was one of those things where it was like, it matters that you have someone who's got experience and who's real estate specific. Because I've known people, and I don't want to knock on them, but I know people who are like, well, it's whatever, and they just go to HR Block and say they'll figure something out. Like, real estate is a whole sector when it comes to taxes. Mm-hmm. So it's like, and so I almost you can almost think of it like a doctor. You go to the hospital, but they're specialists, right? You don't want to go to the foot doctor for your heart, right? It's complex. Real estate is complex, and it's your money. You want to care about the complexities of it. Find someone who knows, because what you don't want is someone who's winging it for you and maybe not claiming the depreciation on the rental. Those things matter. So now, obviously, we invest in real estate because for a lot of reasons, but one of the reasons is real estate is a method that the wealthy have obtained their wealth over, it's one of the main methods, right? Is through holding real estate, buying real estate. What are some strategies that you've seen wealthy people practice when it comes to just taxes in general?
Well, the first thing is, when they do the analysis for the deal, they're looking at the tax effect. They're looking at after-tax dollars. What's my return on after-tax dollars? Their return on investment is based after the tax, not before the tax. So a lot of small investors are looking at, if I flip this house, I make $5,000, and all this is like, well, no, you've actually, yes, you made $5,000 gross, but you've got some tax that you're going to owe on that. Granted, you have expenses, but you need to plan for that. If you buy a property to rehab, and you look at everything you're making, and you don't count how much tax you're going to owe after you sell that property, then you could end up having a cash flow loss. You're going to have profit on that, but it's like you want to make sure, it's like you might have been able to negotiate a better deal, or maybe it wasn't a good enough deal for you to do, because after you pay tax on it, you could have spent your time on another deal making even a higher rate of return.
Right.
So you want to make sure that you count that in.
You guys understand the difference between a gross income and a net income?
Yes.
Okay, like gross is, this is how much, maybe I got for the flip, this is how much money got paid out to me. But when it comes down to it, you've got things like taxes, maybe the salary part, just different things, just different expenses. There's a huge difference. So many people you see on the internet, their gross is like, they flaunt their gross. That's not attractive. I want to see what the net is, because the net's what goes into your pocket and stays in your pocket. And that's what I'm interested in, is I care about that net number, because you'd be like, oh, I made $50,000. Just kidding, I really only made $7,500 when all was said and done. Or whatever it may have been, right? Like, that's not sexy, right? It's gross is, everyone talks about their gross income, but when it comes down to it, it's your net. You might have done this gross amount of income in flips for last year, but what did you actually come home with? That matters, and that's going to make a difference on your ability long-term wise to be in real estate.
Right. The other thing that wealthy people do is they set up the appropriate entity for their investment. And another thing is they look at, as part of the planning process, they look at, are there tax credits available? There are tax credits for almost anything out there, and there's a lot of different ones. We're going to talk about that a little bit later with opportunity zones. There are tax credits. You can get historic tax credits. A lot of cities and urban areas have special grants or tax credits you can get if you're fixing up places. It takes planning to get those. Sometimes you got to apply for them. You got to wait for them to say it's okay. And I know with New Orleans, you can get a grant for replacing the sidewalk outside of the building, and you have to apply for it. But if you start working on that sidewalk before they've approved it, guess what? You're next. You're on your own. You can get a grant for cleaning up the facade of the building, making it look nicer. It's like they have that, but the city only has so many dollars it can spend every year, so that's why there's an application process. And you have to know that. You have to get the application in the beginning of the year. If you're at the end of the year and you're really wanting to finish up this deal, it's like there may not be that money available. But for historic tax credits, it's a big part of it. But there are rules. I mean, the IRS doesn't like giving away money. Congress passes the rules. The IRS comes back and writes regulations to make sure you can't get the money that Congress gave you.
And like hurdles too. They're like, here,
all this other stuff. And so with tax credits, it's like, you have to go through all these hurdles to get to the part, and then but you can get benefits from that. The state also has historic tax credits that you can get. It goes along in tandem with the federal one, because it basically goes through the state, because they're the local historic Park Service or whatever that actually approves the credits that this building is okay. And then the difference between a state tax credit and a federal tax credit is you can actually sell the state tax credits in Louisiana. Not every state you can sell them. So that means as soon as you're awarded the credits, you can use them to reduce your tax, obviously. But you can turn around and sell them, and say you sell them for 90 cents on the dollar or 80 cents on the dollar. you're giving up a portion of the credits that this investor's gonna get, and they're gonna be able to use the credits, but you're getting money to pay down on your note, to cover other costs and stuff like that. The federal credits are not so easy. You gotta set up this really convoluted structure to do that. You basically, if you transfer historic tax credits, you have to have the person you're transferring to as a partner in your deal. And so you have to structure it that way, and then you have where you buy them out after a period of time. So there's all these rules, and it can get really expensive. So you see this happen a lot more with really big commercial buildings.
Well, so when it comes to like credits like that, the things you were talking about, in general, it comes back to this sense of being an active and educated participant when it comes to tax. You didn't know about them, you couldn't be strategic and sell or whatever thing you can do, right? Or you say, hey, look, I'm buying this house here and I get historic credits. You're just, la, I'm spending my money, but you don't realize, hey, I could be benefiting from the money I'm spending by getting these tax credits. Of course, you have to do the process, but you see, like, being educated, having a good team member, and being involved in the process can help you along the way. I know there's a handful of guys that in my mind, I would say they're role models. They're not local, but, and I actually asked them some questions about, hey, what are some tips you would share about how you changed your mindset about taxes? One of them, the guy owns multiple businesses, and he's like, I care, he's like, I don't care about the name brand stuff I own. He's like, I care about the entities that I own. Those are different streams of income. He's like, I care about, different things I can do. He's like, he did bring up the lending. Like, don't just nickel and dime everything. He's like, great business people run their business like they're going to sell it to someone else later down the road, right? So if say if I were to sell my business, one of my businesses to follow down the line. If I'm with show making very little money because I'm nickel and diming and doing everything, it's not going to look good to him on paper, right? And if I'm saying, oh, what all the things can I write off, and they're just frilly things that don't really go with the normal operating procedures or things that are normal for the business, it's not going to look attractive to him. That's one thing to think about. Some people truly building businesses to sell them. I mean, I know a guy who's like on his like 5th lawn care business that he's selling. He'll build them up, and he'll build them up to where there's structure and all this stuff to where they're good on paper, and then he'll sell someone who just wants a turnkey business.
Well, let me just say this along those lines. You guys are out there looking for property. One of your targets is landlords who are tired of being a landlord because they're not running it like a business. They're just tired of all the other stuff. And it goes the same thing. If you're not running your business like a business, you're going to be a tired landlord of your business.
Right.
So
you're going to be mismanaging
you're going to go in and buy this rental property for a low price, but the person just wants to get out. They want to get some cash, and then they want to be out of the debt or whatever it is. And you're going to get a deal because you know you can come in and turn things around. Same thing if you have a business that has some assets, that has some value for somebody, and you're not running it right, they're going to see a value where they can go and they can grab something of value for cheap. And they're not going to pay you what it really could be worth if you're not running it as a business. And part of that is also with systems, like she gave away E-Myth, was that it?
Well, E-Myth Revisited.
One of the things I was at, and it talks about how you build up systems in your business. You've got to have systems for everything, and if you put systems in place, then that's how everyone does everything. It's just basically
Like a franchise
really simple,
model.
but and it's like, so if you have employees, everyone's doing things on a consistent basis, your value of your business will be better because you have consistency, you know, you can plan for things, and that's part of what you're doing by running it as a business is you want to make sure you can have all that set up. And it doesn't have anything to do with taxes other than it affects your growth and income. I'm more about growth and income than I'm about, let's see how small your tax bill can get. So I'm going to help you get the lowest tax bill you can get, but I'm more about your long-term success as my client, because if you're not making money, you don't need to come to me to help you make more money,
So one last thing before we hit the last question, and I know then we'll jump into opportunity zones very soon, is it's important to know what your goals are, because how can you plan entities and how can you have plan strategies if you're like, I don't know, just throw stuff against the wall and see what sticks. You know what I mean? So it's like there is a level that you've got to dream for yourself, and you've got to really look at your business and say, what am I wanting to do long term? In the next 5 years, where do you want your business to be? In the next 10 years, where do you want your business to be? In the next 3 years, the next 1 year, where do you want your business to be? And plan accordingly. I have my own goals of where I want, and there's size to it. There's like, hey, there's a level of employees with certain stages. It's hard to be on the same page if they don't understand where I'm wanting to go with my goals, right? Hey, well, when I build an entity, it may not help if I'm like, oh, well, I eventually want to have 50 rental properties. Oh, and I want to also be doing 20 flips a year. Then it's not helping. The advice isn't necessarily helping. So that does come to play. So one of the last questions before we hit the opportunity zone soon is, if people listening on the live stream, which by the way, if y'all aren't connected with us on Facebook, we do archive these by doing Facebook live streams. So if you want to go back and watch it or recommend it to someone. If someone either watching or here tonight, what would be one thing you recommend if someone can change the way they think about taxes to be able to increase their business and overall make positive changes? What would that be?
Well, that would be, it's sort of been a theme through the whole night, is that you got to plan for taxes. You know you're going to have to pay it. So it's a cost of doing business. You got to make sure that you're planning for it. And before you do a deal, think about what are the tax consequences. What do I have to put in place, or am I going to? Are there other things I can do to help make this even more profitable because of tax credits or something like that?
Like sell it 356 days later, instead of 365.
Have the intent, the planning on, looking at the whole thing and what can you do. So that's basically it. It's planning, secret of saving taxes. So
he's going to real quick share about opportunity zones. I put on our website, the LA North Shore RIA site. Under the upcoming meetings tab, I've been putting like handouts from different speakers there. He has an article he shared. I'll share it on social media as well, to kind of like, remind y'all. But it is an article on this topic. But what are a lot of people, how many of you guys have heard of this opportunity zone thing? Okay, it's getting out there. I mean, to the degree that we did, tell you about it. About tonight, was we talked about. But what is this opportunity zone thing, and what is it? What is it? How does it affect investors?
So last year, Congress passed the law for opportunity zones, and it's what's cool about it is if you buy a property and fix up a property in an opportunity zone and you hold it for 10 years as a rental, since we're talking about real estate, it can be other assets, but we're talking about real estate. Then when you sell it 10 years later, tax free. So that's the big benefit. Now, what a lot of people are really big on is that if you've sold an asset, either a property or stocks or bonds or anything, and you have a capital gain on it, you can, if you invest that gain in an opportunity zone property, it deferred, you don't have to pay a tax on it right now. And if you hold it for 5 years, they forgive 10% of the tax on that gain. You hold it for another 2 years, they forgive another 5%. So you get you're only going to pay 85% of the tax you would have owed on that. But at the end of 2026, which is 7 years away at this point, you get taxed on that money, even if it's still invested in your property. But that's just to try to get people that are the big investors out there that are selling, billionaires, I guess, that are selling all this stuff to invest profits into these opportunity zones. Now, the opportunity zones are designated by the state, economic development, the governor, or whatever, and they're based on census tracts with low income. They're trying to spur investment in lower income areas. That's why they call them opportunity zones. So if you go online and you Google opportunity zone map Louisiana, the first ranking item on that will be the Louisiana Economic Development, and it'll have a map to the Louisiana map. It'll also, below that, it has a map to everywhere in the United States. Every state probably has opportunity zones. I haven't looked at every state, but when you pull it up, you see the dots all over the place. Now, it turns out what's crazy about this is based on income data from the census data, because basically the state recommends it and the Fed approves it based on the census data. Well, guess what? The whole CBD in New Orleans is in this. So, yeah, I want to buy a big high-rise building, improve it a little bit, and then sell it in 10 years.
Yeah.
Makes a few $1 million tax-free. But you can do that anywhere. Now, it turns out here in St. Tammany, if you go in there, it's like there's an area that's over, it's I-12 and Highway 11 going towards Pearl River and sort of northwest of Pearl River in that area. That's the only area in St. Tammany.
Like Alton area?
Alton, and up in there, and there's a little industrial park right off of, I-12 and Highway 11 there, in that area, and a lot of farmland.
If you're looking for land, my family has a big tract of land over in that area.
Yeah. And so, now
We're
remember,
sitting
you gotta
on
hold,
Fricky Road.
yeah, you gotta hold it for 10 years to get the big benefit. Now, it turns out that you can invest, I think the year is, I'm not sure the last year you can invest in, it might be 2028, is where you can actually buy a property and then you can hold it, but the last year, this provision expires in 2047, so as long as you hold the property up to that time, then it's tax-free. The IRS doesn't know yet what they're going to do if you're still holding the property after 2047.
Yeah.
They're going to have to come up with a regulation. Most likely, what they might do if they want the appreciation to stop, they might say at that date your basis automatically comes and you can get it appraised and say here's what it's worth, and if my basis is there, you start over with the basis being at that level. So you lock in the tax-free, or you lock in the game where it's not taxed at that point.
So is this only for people looking to hold? Or
Yeah, well,
this-
so.
Like what
Yes,
type
but
of
the
investors?
opportunity, so if you want the tax-free gain, yes. If you're a realtor, or you're a flipper, or a wholesaler, you want to be looking in the opportunity zone for properties you can get under contract, and then go find a guy that wants to hold that sucker for 10 years. And then you can make money. Now, you don't get tax-free gain on it, but
It's a selling
it's
point.
a selling point. So you want to be looking at those areas. Where are they in every parish? Algiers, a big part of Algiers. And I don't know if the lot you were talking about is in there, but if it is, did you look that one up and confirm it?
It is not.
But there's a lot of swatches of that part of the West Bank that is in there. Now, when you go to these maps, you can actually type in an address and it'll tell you whether it's in one or not. So it's easy to find. For Tangipahoa Parish, it's basically from Tickfaw up to Meat and west of I-55, so basically Independence and over in that area. And in Washington Parish, it's the southwest corner up to Franklin, and then over by Bogalusa, a little south of Bogalusa, so down to the St. Tammany Parish line. So those are the areas.
Is there a limit for any person or entity per property or on the amount?
No, it's like you can invest, anything you want in it. Now, there's some mechanics to it. There's a bunch of rules, and one of the things is you have to create an opportunity zone fund, which is basically an LLC, and it can't be a single member LLC. It has to file a tax return. But I have a way of getting around it. So if you have an S corp, if you have a flipper entity, it can own 1% of your LLC that's the fund, and you own 99%. You own 100% of the S corp. You still have to file a tax. All the IRS wants you to do is file a tax form, attach a form to it that basically says we're opting to be an opportunity zone fund. And because of the single member LLC, you can't file a tax return because it's disregarded for tax purposes. It has to be a partnership. So you can structure a partnership.
So basically I could partner with one of my other entities.
That has to file a tax return, and then you're, and you can invest any amount of money in it. Now, it starts with if you set up the fund and you invest in the property, then you